Welcome to this explainer. Look, today we are going to completely change how you view the stock market. Seriously, forget all those confusing charts and Wall Street jargon. We're diving right into the ultimate ownership secret. Let's kick things off with a pretty shocking fact. Most people hear the word stock and they instantly picture a ticker symbol flashing on a screen, right? Or maybe that old saying, buy low, sell high. But what if I told you that buying a stock actually means becoming a business owner? You're not just trading some meaningless number. You are literally buying a real piece of an actual operating company. But here's what most people don't know, and this is wild. You don't need millions to do this. Thanks to fractional shares, which basically let you buy just a tiny sliver of a single stock, you can start owning a piece of the world's most successful businesses with just $1 single dollar. Yep, $1. It completely changes the game. All right, part 1. What exactly is a stock? Let's break down the basics of ownership. Okay, let's explain this as simply as possible. Imagine a guy named Bill. Bill wants to start a revolutionary new cell phone company, and he figures he needs $100,000 in startup cash to get it off the ground. But problem is, Bill only has $60,000 in savings. He's exactly 40 grand short. So what does he do? Well, he forms a corporation and chops the ownership up into 100,000 equal pieces, or shares. Then, he convinces a friend to invest that $40,000 in exchange for 40,000 of those shares. Now Bill owns 60% of the company, and his buddy owns 40%. By splitting the company into shares, he easily raises the cash he needs, and his investors officially become part owners. So the crucial takeaway here is that a stock or a share, since people use those interchangeably all the time, is really just a legal slice of the company pie. It's a true title of ownership representing a fraction of the capital in that business. On their own, Bill and his friend couldn't launch the company, right? But through stocks, they made the whole shebang happen. Moving right along to part 2, going public. Why do companies even issue shares in the first place? Let's scale this up. Why do massive corporations issue shares to the public? Well, they do it for a few highly strategic reasons. First up, capital. They need massive amounts of cash for expansion, like entering brand new markets or building giant factories. Second, selling shares is a fantastic way to pay down debts without taking on more crippling interest. It also provides liquidity, which basically means early investors can finally cash out and reap their rewards. Oh, and companies can literally use their stock as a currency, trading their own shares to buy out other businesses. Plus, it's a great way to motivate their top employees with stock options. To see how this brilliantly works in the real world, let's look at Amazon. When Amazon went public way back in 1997, they didn't just hoard the cash. No way. They used the capital raised from that initial public offering to invest heavily in their infrastructure and technology. And that specific move laid the absolute groundwork for the massive global e-commerce powerhouse we know today. Tesla is another absolutely perfect US example. Becoming publicly listed boosts a company's brand immensely. Tesla used the public markets not just for cash, but to gain huge brand visibility, attract customer trust, and lock in strategic partnerships. Going public acts like a giant form of brand endorsement for the entire world to see. Honestly, every time the stock ticker is mentioned on the news, it's basically free advertising. All right, part 3, types of shares. We're looking at common versus preferred stocks. Here is a fascinating detail that actually gets overlooked a lot. You have a choice in the type of ownership you buy. There are 2 main types of shares. Common stock is what most people buy. It gives you voting rights on major company decisions and offers a high potential for capital appreciation, meaning your shares can grow significantly in value. Preferred stock, on the other hand, is for folks who want a bit more stability. You trade away your voting rights and some of that explosive growth potential, but in return, you get fixed, steady dividend payments. Plus, if the company ever goes bankrupt, preferred shareholders are actually closer to the front of the line to get their money back before common stockholders do. Now, no matter which type you buy, there are core risks you absolutely must consider objectively. We're talking about capital loss if the company's value drops, volatility from daily market swings, and liquidity risks, which really just means you might not be able to find a buyer exactly when you want to sell. But hey, understanding these risks upfront allows you to make calm, informed decisions without the fear. Next up, part 4, price movements. Let's talk about supply and demand. This brings us to a question we all ask. Have you ever wondered why those stock numbers flash green and red all day long? Well, without needing any complex math or advanced valuation models, price movement simply comes down to the most basic rule of economics: supply and demand. Are there more buyers or more sellers? Supply is just how many shares are available for sale. Demand is how many shares people actually want to buy. If demand exceeds supply, buyers compete and prices go up. If supply exceeds demand, sellers compete to exit and prices naturally fall. It really is that simple. Here is exactly how that plays out step by step. Let's say a company reports earnings that absolutely smash expectations. Positive news breaks. Immediately, demand spikes because investors want a piece of that success. But current shareholders, they hesitate to sell. Because buyers are rushing in, they literally have to bid higher and higher prices to convince existing owners to let go of their shares. The price climbs rapidly until supply and demand find a totally new balance. Moving to part 5, busting myths and uncovering investing truths. Let's tackle some of those common beginner mistakes and myths that keep so many people saving sitting on the sidelines, literally just losing value to inflation. First up, the biggest myth of all, that investing is just like gambling at a casino. Actually, scratch that. It is fundamentally different from a zero-sum casino game. When you gamble, the structural odds are entirely stacked against you. But when you invest in the stock market, you are backing real, revenue-generating businesses. Historically, the market trends upward because economies grow, companies innovate, and earnings increase over time. We also need to bust a few more limiting beliefs. For instance, you don't need a massive Wall Street terminal to succeed. Literally anyone with a smartphone can start today. We also got to drop the idea that a $2 stock is always a better deal than a $200 stock. A low price tag might just mean the company is failing. It tells you almost nothing about its actual fundamental value. And finally, checking your phone every hour does not make you a better investor. In fact, frequent monitoring usually just leads to overreacting to short-term noise. Honestly, a quarterly review is more than enough for most people. All right, we've made it to part 6, the golden rule, the best strategy. It is time for the one powerful takeaway that the world's best investors live by. If you remember just one thing from this explainer, make it this: time in the market beats timing the market. The idea that you have to buy at the exact bottom and sell at the exact top, it's a total myth that even professional fund managers fail to achieve. Studies actually show that missing just the 10 best trading days over a 20-year period can cut your total returns by more than half. Consistency and patience are absolutely your best tools here. So thinking about all those brands you use daily, what real-world company would you want to own a piece of today? If this explainer helped you understand the true power of owning stocks, hit subscribe and click the next explainer on your screen to continue leveling up your financial journey. I'll see you there.